Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
When I met you in the summer.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome back to another episode of the Equity Mates Summer Series. We really hope you're having a great summer as well as enjoying this series. This podcast explores everything that is possible in the world of investing. And if you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Very excited for this series as we unpack lessons from a lifetime of investing from some of the best fund managers and advisors in Australia. And we really try and draw out those actionable insights that we can take away and apply to our own investing in 2025, because 2025 is going to be our best financial year yet.
Yeah.
Yes, you heard me. Yes, I'm calling it early, but it's happening.
Wow.
Sorry to tell you.
Wow. Well, what a way to start. I am excited to see how the year pans out. But today we are joined by a guest that we love listening to and learning from, and that is Scott Phillips. Scott is the Motley Fool's Chief Investment Officer. He has been there since 1999 and is advisor of the Fool's flagship investment service, the Motley Fool Share Advisor. He's a regular columnist for the Sydney Morning Herald, The Age and Money magazine, and has had various roles in sales and finance before joining the Motley Fool. So plenty for us to unpack with him today.
Now, there's heaps that we took away from this interview. It was one where we were just writing so many notes for things that we could clip and put onto socials. So make sure you're following us on socials if you're not already. But I think his personal journey is going to really resonate with a lot of people. It's certainly resonated with me. Like, he is very much the self-taught investor. You know, his parents told him the share market is a casino that he should avoid.
Yeah.
He started his career in, non-investing roles. Like, he started in business, just working for businesses. Corporate, there we go, that's the word I'm looking for. And then he decided to take the leap over to finance just by cold reaching out to the Motley Fool when they came to Australia, started writing for them for a bit and then ended up working for them full time. And I think that process of self-education, of not having like any formal training or any upbringing as investors, but being self-taught and figuring it out and realizing that you can do it yourself is a journey that we've been on, and I think is a journey that a lot of the Equity Mates community has been on. And I think the resources that Scott shares, the way that he learned, I think is really valuable for people who are trying to take the next step in 2025.
Yeah. Now, stick around towards the end of this episode. Scott also reveals almost every position in his portfolio. Yeah. So,
and the one ETF that he owns.
Yes.
So maybe you can try and guess which one that is.
So a lot to come, but before we get into it, a huge thank you goes to Viola Private Wealth for supporting this series. Viola Private Wealth specialise in managing and growing assets while helping families pass on their wealth with confidence. Managing over $2.5 billion in assets, their approach goes beyond financial planning. It's about creating a legacy that lasts. With decades of expertise, they guide families through the complex terrain of intergenerational wealth planning, crafting strategies that stand the test of time.
Trusted by members of the Equity Mates community, Viola Private Wealth helps individuals grow and protect their wealth. To learn more, visit violaprivatewealth.com.au.
All right, without further ado, here is Scott Phillips. Well, Scott, welcome back to Equity Mates.
Bryce, g'day. Thank you for having me back, guys. It's good to be with you again.
Really looking forward to unpacking a fair bit about your early days in your career, your investment philosophy, and some of the major lessons that you've learnt along the way. But we want to start with the journey of investing. It's lifelong. It's, something that we're always working on and really never mastering, so to speak. So with that in mind, what are you working on right now?
That's a great opening line. It's one of those things, right? The more you learn, the less you realize you actually know. And so I'm in that space of trying to pare back what I really do and don't know. I'm trying to balance, guys, at the moment, the uncertainty of future growth with the potential for that growth to be really explosive and really impressive, right? And so you're kind of in this weird space of the less you can know for sure, the greater the risk of an investment by definition. However, there's a million examples we can throw out there, right? Everything from Canva to Amazon and everything besides. And I own Amazon shares. Even at that time, when Amazon wanted to be the world's largest bookstore, that was a very, very long time ago. And these days, obviously, just massively, massively bigger. NVIDIA, great example, right? The chip maker that's gone to the moon. Was it always going to? In hindsight, we say, of course it was. At the time, I don't know. So I've probably missed out on more than my fair those kind of big rockets onto the moon. Because I looked at it and gone, I don't know. And tapping those odds, I'm trying to get better at, yes, not losing money chasing, the stuff that doesn't come off or work out. You're always going to if you try to play that game. But also allowing for that uncertainty, but also the growth and kind of trying to get those probabilities in my head set right so I don't miss too much upside, but I also don't suffer from too much downside.
Well, if you figure out the perfect formula there, Scott, let us know, because I think
I promise you I won't, but I'll do the rest later.
Now, one thing that we're really interested in unpacking throughout this series is how the expert investors we speak to learn, because the beauty and the challenge of investing is that you really have you have the opportunity to invest in companies across any sector, and to make investment decisions, especially if you're investing in individual stocks, you have to develop some level of expertise or knowledge around, sectors as varied as semiconductors to the waste industry and everything in between. So what's your process to firstly keep up to date day to day, but then also develop that deep domain expertise that you need to make investment decisions?
So the great thing about investing is it's cumulative, right? So I used to have hair when I started this. And the good thing about exactly. The good thing about investing is every time you learn something, you add it to what you already knew. And so you kind of don't have to, at a principal level, even an industry level, learn from scratch very often. Now, you mentioned semiconductors, AI, something we're all learning from scratch, right? So you have to do that from time to time. But the concepts and principles of investing, for starters, you kind of build on top of. You're not having to relearn from scratch. And the same with industries. And Charlie Munger, God love him, who's now gone, talked about a framework or a lattice work of mental models. So it's trying to find ways of contextualizing new information. What does this look like? What rules does this follow? How have I seen this before? Where are the sort of similarities or differences? And so you it's a nice way of paring down the decisions you have to make. Like every bit of behavior, you had to think every single moment of every single day, when to take a breath, when to move a hand, which leg to lift up when you're going to walk. You couldn't, you'd be paralyzed. So taking what you already know and adding to that is kind of how you do it. That's how you build it out. I will say one thing too, by the way, and this is, I'm proud of being humble, right? So I try to be humble where I can. You talk about deep domain expertise. I'm going to say that you don't need as much deep domain expertise, as much depth as most people might suggest, because it's not going to be, well, very, very rarely, the 1,000th hour of research into the waste management industry, to use your example, where I finally go, now I understand what makes it work. Now I understand who the winner's going to be. Now I understand why this is mispriced. It's just really, really unlikely. And so you need to know enough to make a good decision, but it's very rare that, it's the old 80-20 principle. Once you get past a certain point, you don't necessarily want to go deeper. And the great example is you have industry insiders who still lose all their money because they think they know everything about a thing. Technically, they know the stuff, but the bigger pieces of the competitors, the suppliers, the dynamics, the macro environment, geopolitics, that sort of stuff, the broader concepts are kind of where it matters. So I wouldn't say to people, don't do the research. Yes, you really need to understand these businesses. But once you kind of get how they work, the industry works, the competitive dynamics work, you've gone almost as far as you need to go. I've never owned an airline. I owned some Rex shares a very long time ago. But since then, I learned my lesson, like most people. And so you kind of go, okay, well, what more do I need to know to invest in airlines? I don't. I say, well, I've stopped at, this is a really capital-intensive business with no pricing power, really high fixed costs, operating leverage that will kill you as soon as things go badly. No, I'm out. And that's about as much as it's simply when I'm investing in something. The basic broad principles that apply to a good investing, yes, you have to know about the industry. You've got to know what's going on, who's going to win, who's going to lose, where the power sits in industry. But those are the really important parts. So I think if you refine down, again, it's a bit Charlie Munger. Quick recommendation, by the way, The Psychology of Human Misjudgment. It's an awfully wordy title. It is a spectacularly good speech Munger gave. It's been represented in a book called Poor Charlie's Almanac. And he basically says, look, once you master these key principles, that's about as much as you need to know. Deep domain expertise, I think, is overrated, which sounds, again, almost like I'm being neglectful or somehow, not putting the work in. But it's really putting the detail you do know into the right frameworks and contexts to make the right decisions.
Love that. We'll put a link in the show notes to the Psychology of Human
Misjudgment. Yeah.
Nice. We'll put a link to the show notes. Now, Scott, we are witnessing a pretty remarkable year for markets at the moment, accelerated by the result of the US election. So how are you thinking about taking advantage of the opportunity versus managing risk at a time like this?
If you invest in businesses that are exposed to very specific risks, you better be paying attention to those, right? If my business is going to die or succeed on the basis of a particular outcome or political decision or policy implementation, then frankly, I wouldn't own it. But if you do own it, you want to be really, really, really careful and be paying very close attention and riding that wave. Now, I reckon that's really hard to do. You have to be right about the outcome, right about the impact of the outcome, and then you have to buy it and sell it at a price the market hasn't realized. So where's your competitive advantage, right? Where's your variant perceptual point of difference? Where do you get the outsized performance from? Really, really, really hard to do. So I've got to say, I've done absolutely nothing differently before, during, or after the US election. Do I think it'll be volatile? Yeah. Do I think the economy is going to have some rough times? Yeah, absolutely. Am I mindful that there might be some economic challenges that come from, for example, if the US does go ahead with 10% universal tariffs and 60% on China? Yeah, absolutely I do. So those things are really risky economically. But we're talking economically like, am I between 2% growth and 1% growth, or 1% growth in a small recession, or a small recession and a big recession? But if I'm a long-term investor, guys, and it sounds really boring, and if it does, great, because I've got my message across. I'm investing for the next 5, 10, 15, 20 years. I'll be investing right up until the day I die, good Lord willing, and the creeks don't rise. So we went through the first Trump presidency, right? And I did nothing different there. Then we went through the Biden presidency. I did nothing different there. And the next Trump presidency and the one after that, whoever comes, whether Trump managed to change the constitution to get a third term, that's something people have been talking about. So who knows? But no, so look, guys, honestly, it sounds neglectful. I don't know that I can do anything particularly different, given what I know, what the market already knows, what the prices already are. Everyone's already factored that in. So the chance of being able to outmaneuver faster traders, day traders, short-term traders, frankly, it's really small anyway. Secondly, I don't have any particularly unique insights. So what would I trade on? I go back to, I want businesses that are going to survive and thrive over literally decades, again, which sounds like I'm being neglectful. Who thinks in decades? I try to, at least 5 years. So my investment horizon is already post the next presidential term. So I'm not changing anything at all. As I said, if I was exposed to particular things, I might. So again, I'm not saying anyone listening should ignore that. But if you're investing what I think is the right way, how's that for arrogance? If you invest the way I invest, you don't want to think, it doesn't matter. In fact, you can only probably be misled by trying to think about that when you should be thinking about what actually matters, which is this a good company? Has it got a bright future? Is today's price attractive relative to that bright long-term 5-year plus future? It's kind of all that matters to me, at least with my investing.
Yeah, nice. Love that. Well, Scott, that will be the only question we ask you about the market today in the US election, I think. So we want to really unpack, lessons learned from your journey as an investor, and we want to go back to the beginning of that journey. So Take us back. What was your introduction to investing?
Back when TV was in black and white and dinosaurs roamed the earth, exactly. I sat around the dinner table at home in high school, and my old man said, the stock market's a casino. It's all gambling. Why would you bother? And that was really common. Now, again, I'm very old. This is before all the privatizations, right? So this was the time when brokerage was $150 a trade. You had to have $1 squillion to invest in the first place. No one really understood the markets. And all you saw was the gyrating index value at the end of the news bulletin every night. That was the share market, right? So I don't blame the old man. He was a fiery by trade, right? So he was in the finance game. So that's where I started. I was really lucky. I had a kind of a bent for economics and for commerce. So I vividly remember in year 7 or 8, my teacher saying me the price would be set with a supply and demand interact or intersect, the old supply and demand curve. And I put my hand and said, but businesses will just supply whatever they can to make the most profit, won't they? Like, just stop, Scott. That's next year. That's the year after. Like, that's sort of supply and demand for now, right? So I was already wired that way. I don't say that as a boast. It was just some people are wired to be able to do stuff with their hands. Thank God I don't build houses, mate, because none of them would be useful. So I kind of had that anyway. Year 11 and 12, I had a great economics teacher, Mr. Barnett. And again, let me tell the kids about the olden days. Stock prices were only available in the newspaper. You know why, kids? Because there was no internet. I know. So we literally got the Australian Financial Review, went to the middle section, and we went through the columns of each of the company code, company name, dividend yield, price earnings ratio, market capitalization, literally. And at Monday, they had the full market. During the week, I think it was the ASX 200 or the All Ords, whatever it was then, as part of that. And that was my kind of turn on to, hey, this investing thing is a thing. But you can invest in BHP, you can invest in CBA, you can invest in some of these companies. The other one was a great man. That was Mr. Barnett. I'll give him a rap, Alan Barnett. Sydney Moyer was my year 8 or year 9 maths teacher. And he talked to us about compound interest. And again, light bulb moment, hang on. And he said, I can never remember the numbers. It was something like if you invest $1,000 a year between now and some year, you'll be a millionaire by the time you retire. And I don't remember the details, and I could probably recalculate it, but I don't remember what he actually said. But what it reminded me, or what it showed me very clearly as a light bulb moment, was compounding works. As you add those two together, and that's kind of how I effectively got into it. You throw on top of that the Telstra, IPO, Woolies. I worked at Woolworths when it went public. I think I got some shares. I could buy some shares. I can't remember what it was at the time. I don't own them anymore, unfortunately. So those kind of things were happening around us. The NRMA was demutualizing. It was all in the zeitgeist at the time. The last one really quickly, guys, was, and this is... they say you're a product of your childhood when it comes to your approach to investing. I was lucky enough, again, think about this. I had a passbook savings account where they literally printed the details in a piece of paper. Again, kids, ask your parents. But I got 6 or 7% interest at call on my savings at that point, right? And just for that very short period of time. By the way, that also coincided with the 17% mortgages. So paid more for mortgages, got more for savings. I wasn't paying a home off, but I was saving money. So that idea of like, man, I get paid for doing nothing. I get paid a lot of money for doing nothing. Roll all that together. Now, I did other stuff before I joined the Motley Fool as an investor, as a trade, but that really is what spiked my interest. Those combination, really lucky combination. Most of our lives are luck, guys, no matter what other people say. I was really, really, really lucky. Great family, great education, couple of great moments in economics and business in the society in general at that time. And that's how I got started.
Love that. My key takeaway there is that if you're only getting an update in the paper once a week for total stock market prices, that's pretty relaxing.
That's the thing,
compared
right?
to live data.
Yeah, and you got the daily for the broader market. The full details are only once a week. But even then, you'd have to pick up the paper and bother having a look.
Yeah.
And so you just wouldn't, because why would you? And you're absolutely right. The democratization of access to the market is really, really, really important. You guys wouldn't exist. The Motley Fool wouldn't exist without it. But there is a really dark downside, which is the refresh button, 6 hours a day, 5 days a week. You keep hitting the button to see what your share price are doing. You're right. The market existed, by the way. People make a lot of money when the stock prices are only printed in the newspaper.
I know. Now, we've stalked you on LinkedIn, Scott, as you as you alluded to there. You worked in a number of non-finance and investing roles before making the leap across to the Motley Fool. So maybe talk us through a bit about that period of time. What was the thinking to make that leap?
So when people quote Buffett, you kind of go, oh, here we go again. Buffett has said really clearly he's a better businessman because he's an investor, and a better investor because he's a businessman. Now, these days we might say business person, but that's the direct quote. I learned about investing kind of on the side, right? We just talked about that. I went through uni, started kind of investing on the side with, the shillings and pence that I had at the time. And as I did that, I kind of noticed the overlaps. And what I found was that I was really lucky. The business roles I worked in, and most of those companies that I did work in before investing, I was kind of the finance guy, but working with the sales and marketing teams. That was kind of my thing, right? So it's that kind of really commercial, they call it commercial management, commercial finance, trade finance, depends on what you want to call it, depending on the individual company and industry. But I was kind of in that role of the guy helping the front end of the business make money, control costs, get better returns on promotional spending, for example. Over time, you see that meshing of, hey, this is kind of, this is investing, this is business. I do find if you've worked with investors who have worked in businesses, they tend to understand business better rather than from the outside. It's nothing more annoying on a conference call when an analyst says, hey, have you guys thought about raising your prices 14% to the... It's like, dude, you've ridden a desk. You've never worked in a commercial business. I get it. If the profits were higher, they'd be higher. I get it. But really, you reckon they haven't thought of that? So there's a bit of arrogance in what I do if we're not careful. The change, though, came about... This is a nice little sliding door. Speaking about luck, right? So I followed the Motley Fool when it was only a US business at the time. Really loved it. Learned a heap from the Motley Fool. Like, it's not a plug, it just is. That's how I learned about most of my investing. I get to 2011, and I read on a Facebook post of all things that the Motley Fool was looking at expanding internationally. And it was a one-line comment from our now CEO and then CEO, Tom Gardner, who said, next step is we'll expand internationally. And that was literally it. And for some reason, I had in my head, I must have remembered somehow from all my reading Tom Gardner's email address or worked it. I can't remember how it happened. So I literally sent him an email on spec, say, hey, mate, look, I love my job. I love what I'm doing. I don't really want to leave what I'm doing. But if the Motley Fool did come to Australia, I'd love to be involved to help somehow. I benefited so much from what you guys have done. If there's any help I can give you, anything I can do, I'd love to be involved. 2 days later, I get an email from the guy who would become my boss, who said, funny you should say that. We're opening the Motley Fool in a couple of months. Do you want to have a chat? I said, literally like sliding doors, right? 2 months earlier, 2 months later, there's probably no conversation. And he said, what do you do? I said, well, I've worked in sales, worked a bit of marketing, I've done some trade finance, did my career story. He said, well, can you write? I said, I don't know. Do you want to have a go? I said, okay, sure. And I kid you not, literally, so I was like, well, okay, write me a 600-word article on this thing. So I did. And it seemed to work okay. So he said, okay, we'll do another one next week. And then it was 2 a week and then 3 a week. So I was doing my job. I was working at Blackmore's and then Goodman Fielder. And as I was doing that, I was writing these articles just in my spare time at lunchtime or after work. And that's kind of how I got into it and seemed to be good enough. 12 months later, the Motley Fool had a permanent job opening. I took that or applied for that and got it. And then we kind of went from there. So very, very lucky. Sliding doors. I found the Motley Fool. I liked investing. My skills ended up being a bit transferable. I had the education from other places. We'll probably talk about that. But take those skills, take that experience, and then kind of help other people invest. And that's literally how I went from working with these companies who I actually still miss it. Like I'm really happy doing what I'm doing, but I miss the kind of the cut and thrust of going and making the sale, helping the marketing team set up the programs, working out what's going. Like I really want to get my teeth back into that sometimes, but love what I'm doing and glad I made the move.
Nice. Love that. Now, Scott, when a lot of people think Motley Fool, they probably think the advertising.
Go on. Yeah. I knew that was coming. You guys have mentioned that once or twice.
Yeah, we have. But yeah. But look, when I actually think Motley Fool, I think of the analysts that have come out of the Motley Fool. Like a lot of them have gone on to build their own businesses in Australia. Owen Rask, Andrew Page, Claude Walker, Matt Joas, yourself, some really prominent people in Australian financial media coming out of the Motley Fool. So we want to understand how you train analysts there and what we can learn from that and what we can replicate from that process. So what is the process when you get someone in the doors at the Motley Fool, and what are the go-to resources that you found are really valuable for people that want to become self-taught investors?
That's a really good question. I'm glad I made the list, by the way. Thank you for bringing me to that list of people. I should mention Joe Mager too, who's an American and back in America, but he's a great guy, a great investor worth following. So it starts with recruitment, actually. So we recruit people who are smart, capable people in the first place. And that's really important because you've got to be able to have the aptitude to actually do what we do. The second is we don't hire traditionally. Most analysts, you do uni, you do commerce or something, then you do a graduate diploma in applied finance. These days you probably do a master's in applied finance so you can get ahead of the queue. Qualification inflation's a thing. I'm not sure you learn a whole lot more, by the way, in those qualifications because a lot of what they do is very, very theoretical and not obviously often applicable. But you want to get the interview, you go and do the course because that's just how they manage the application process these days. And then you go and do that. I've just talked about the fact that if you haven't worked in a real business, you have less of an opportunity. Of those guys you've mentioned, at least half of them had worked in business before joining us. The others were just smart. They come to us not fully formed, but they're passionate about it, right? So we start with aptitude, throwing passion on top of that. And then we kind of do invest or recruit for style, house style. Now, we don't tell any of our analysts what they should think about a company. We have a house view, right? Most people say, Bank of so-and-so says that BHP is a buy. The Motley Fool never says BHP is a buy. Someone at the Motley Fool might think BHP is a buy. Some might think it's a hold. Some thinks it's a sell. And that can be a bit confusing for our readers, and we have to kind of manage that. It's a little bit annoying for some people. I get it. But we don't do that because we don't believe in decisions by consensus, and we don't believe in me at the top saying, you must think this is, make your pitch and I'll decide what it is, and then we'll go from there. Each of our analysts, each of our services have their own view. So we want capable people who are passionate about what they do. We want them to have a house style, and it's really as simple as being focused on the business, not the stock price, not the chart, not the noise, but the business, and be long-term in approach. And we think if you do that, that's half the battle. And then we have really no formal training, guys, really honestly. We do absolutely try and develop our people, but we do it through conversation and communication, right? So we generally have advisors for our services. They're the people who run each service and make the final decisions. We have a team of analysts who work with those people. And that interaction with the team, across the team, with those advisors is a bit of it's quite literally learning on the job. So we don't train the same way, and it's not an easy answer, which is you guys want to say, well, what can other people mirror? If you want to mirror something, find investors you like and admire, find investors who've done well, read and read and read and read, and then read some more, but read useful stuff and learn from those. Sir Isaac Newton's quote is probably my favorite. I've got a lot of favorite quotes, but he said, if I have seen further, it is by standing on the shoulders of giants. I firmly believe that to be true for everybody. There's nothing new in investing. There are new companies, there are new industries, but when Ben Graham wrote his book in 1929 or 32, whatever it was, the Intelligent Investor and Security Analysis, when Buffett picked that up, what's really changed in the fundamentals since then? Not a lot. Understand the business, understand competitive advantages, understand why they're going to be successful, find a reasonably good price, keep your temperament under control. Those are kind of the things that we tend to focus on. And that's kind of how we bring our team. We take what they've got. In the US, we've got science PhDs, we've got all sorts of people from all sorts of walks of life. Tom and David Gardner, who started the business, by the way, they had family in the business. They were English majors. They did effectively an arts degree each at uni in the US. So we're not trying to pump out cookie cutter analysts. We're trying to take what people bring to us, add what we think we do reasonably well, learn from each other, and try and be better as a result.
Scott, we're just going to quickly pause here to say a massive thank you to Viola Private Wealth for sponsoring this series and helping us keep our content free here at Equity Mates. Transferring wealth is as much about family harmony as it is about finances. With expertise in investment management and tax-efficient planning, Viola Private Wealth ensures assets are preserved, relationships are strengthened, and your legacy endures. For more information, head to violaprivatewealth.com.au.
Now, Scott, throughout that, you hinted at a few characteristics that form your investing framework within the Motley Fool. So I want to turn to your investing philosophy and start with your personal view. How would you define your personal investing philosophy?
Yeah, I'm going to repeat myself. So I literally, this is not a plug for the Fool, I learned my investing from the Motley Fool. In 1998, I found a funny named business mentioned in the Sydney Morning Herald, again, a physical newspaper because it was early. And I looked up fool.com in the US, which is where it was. And they used to publish, believe it or not, guys, for the advertising blitz, they used to publish about 4 or 5 articles a day, 8 on a good day, right? And so I would literally read the entire thing. And it was ad supported at the time. We weren't selling memberships. So I was just literally, I used to read everything they wrote. And some of the OGs that are still there are the people I learned from. And so no surprise, my investing is not miles away from where I started. So it is literally long term. I am investing for 5+ years all the time. Quarterly numbers, half-yearly numbers are interesting. They tell you where the company's on a journey. But it's always in the context of that 5-year approach. I've never looked at a chart to make a buying decision in my life. I don't care whether a share's up 50% or down 50% before I buy it. All that matters is what comes next. So business focus on long term are all that matters. That's the fundamental investing philosophy that I start and finish with. I don't want to talk about 12-month price targets. I don't want to talk about this month's earnings. I don't even care about last year's profits, right? What I care about is underlying earnings power. Not this year's earnings, not last year's, next year's earnings. If they're cyclical, if they're one-off impacts, hey, we've been through COVID, we know what that's about. Then what is the underlying earnings power of this business? What is the fundamental driver, profit drivers? How much can they make on average over a long period of time? And then am I paying a decent price relative to that underlying earnings power? And investing doesn't need to be any more complex than that. In fact, I spend more time on the psychology of investing, my investing temperament, than I do on the nuts and bolts of the spreadsheets. Why? Because everyone's got the same data. Do I have more data than the 7-figure analysts working for managed funds or stockbrokers? No. Do I have quicker access to that data? No. Do I have more access to the insiders than they have? No. What do I have? I have the ability to focus on what matters, the ability to stay long-term in my decision making. I don't have 3 or 6 month investor targets. I don't have people churning in and out of my funds. And I have a temperament which says over the long term, doing the right things the right way will more often than not give me the right results. So that's the broad approach. Stylistically, I tend to like consumer-facing companies. Why? Because their competitive advantages generally tend to be clearer and easier to understand. If you find a company supplying another company with a product and it's a B2B bit of software, you can kind of work out roughly what it is, but having not used it or been part of it or understood it, you kind of rely on second and third hand information. Will it keep being popular? Will it be more successful? Will it grow? It's harder to really get a grasp on. But we talked about some companies earlier on, Woolies or CBA. We can understand their business reasonably easily. We understand what's going on in those businesses. And I'm not a value investor, but nor am I a growth investor. I really try and sit in that middle part. I love paying a cheap price. I do tend to like businesses that are out of favor on a short-term basis. Think about retailers 2 years ago, right? COVID hit, everyone's in trouble, everyone's selling retail stocks. I mean, we had single-digit PEs for some of the best retailers in the country, or very, very low double-digit. JB Hi-Fi, look at the share price on that thing. It wasn't that all of a sudden it became a wonderful business and then it was terrible and it was wonderful again. It was a great business, had a couple of short-term problems. And investors went, well, that seems bad. I was like, well, hang on. Again, back to underlying earnings power. I will repeat it. I looked at it and went, aren't they going to be bigger in 5 years than they were last year? Go back to 2019, look at the level of earnings there. Fast forward to 2024 and say, shouldn't they have grown a bit since then? And if I get a chance, no matter what happens volatility-wise in the meantime, to buy those shares while that's happening, that's a pretty good deal. On the other side, I'm prepared to buy stuff that's growing. I think if you see a business that is gaining traction, winners tend to keep on winning. If you can get them at an attractive price, take it. But if not, don't step away too quickly from the juggernaut businesses that are going to keep rolling forward. It's kind of that simple, guys. We have stuff in our recommendations that are P's of 50 and some that are P's of 8. So and the other thing is, I guess I fish where the fish are. We don't have a style mandate with the services I run. We don't just do whatever. Share Advisor is the one I run that I'm probably best known for. We don't tend to go small cap, but other than that, we fish where the fish are. We bought some value, we bought some growth, we bought lots in between. If the price looks attractive relative to the future, it's kind of as hard and as easy as investing needs to be. The trick has been largely staying the course. And the temperament thing, I will bang on about it because, buying well, not because people are excited about it, not ignore it because people are pessimistic about it, buy it because it's the right thing to buy. And then stay the course for as long as your thesis remains valid, no matter what's happening. If share price halves or doubles, it's completely irrelevant. If Mr. Market offers you a great price, by all means sell. If it's a really great low price, by all means buy. Other than that, don't worry about the noise. Let the business do its thing.
Love that, Scott. There's so much there to unpack.
Sorry.
No, it's great. It's great. That's why we're doing this series, because we just, we want to sort of unpack people's investment philosophies, how they approach markets. And I think that's a really great summary of how you approach it. At the Motley Fool, I guess there's a bit of a reputation for seeking the next multi-bagger hot stock.
I want to say next Afterpay.
Yeah, next Afterpay, next Amazon. You knew it was coming. You said it earlier.
I did.
But I guess, when you take that approach and then you think about how you invest personally, how much of what you're doing personally is trying to find those, 0 to 1, next NVIDIA, whatever it is, and how much of it is that, taking what the market will give you, long-term, slow-growing, compounding approach?
Both. So again, because I don't fish with a fisher. So look, you've had me on before. You've been very, very generous before, and you kind of gave me some opportunities to kind of put my views on our advertising, our marketing, and that kind of stuff. My old boss used to say, no one wakes up in the morning wanting to buy an investment membership or subscription service. And so you got to give them a reason, right? And we try and do it. It's a bit grab your attention-y. Call it that. You might call it spammy. I'll say grab your attention-y. The aim is, someone said he wins the race. Buffett was asked years ago, Munger was asked years ago, why do you keep telling people about this? Won't everyone just copy you? And Munger said, well, if you do it 50 years, no one's copied us yet, or at least not enough people, right? Everyone wants the hot new thing. And so what we try to do largely is, we have different services, by the way, for different investing temperaments. We have a service called Extreme Opportunities. It's not an ad, don't buy it, just mentioning it, which actually does go for some of those big upside, but also big risk. So, in fact, that service, Trevor, who runs it for us, says he reckons he'll be right about 4 times out of 10. In other words, he'll be wrong more than he's right, but the ones that he's right about, he expects will do better overall and cover the losses. So that's a very specific investing approach. And that's very Motley Fool Rule Breakers in the US is run by our co-founder, David Gardner, or was. And he set that up in a very similar way. And it was, he grabbed the Amazons and the NVIDIA's a stupid bagger for them. I don't know what the number is. It's out of control. And kind of let it go. It's like, I want to find the disruptive companies that are going to break things and make things and invent things. He says, both proudly and sheepishly, he's got more losers than anybody else at the Motley Fool. And it's because that investing style gets in there. Now, that's not my style, generally speaking, right? I'm more middle of the road. A bit of both. I've absolutely bought and recommended. Some companies have done extraordinarily well on that sort of growth story. And the next Afterpay or the next Amazon doesn't need to be, hey, here's an idea with no revenue, no profit, $14 million in the bank, and they're going to try and be the next Afterpay, right? I'm happy to say, show me the success, and then I will jump on. So we're not saying the next Afterpay before it becomes the next Afterpay. We're saying the upside potential of, if this business can compound at high rates, then it will be quite successful. Trying to be style agnostic and say, this recommendation, what do we like best? And sometimes it's SOL-PAT, sometimes an ETF, right? The NASDAQ ETF's done really well for us. Sometimes it is a big grower like Corporate Travel Management or Goodman Group or something else. So I try not to be bound by that. The other thing is, I've got a team of people working with these other reasons. So I'm neither, well, the mistakes are my fault because I'm the one who has my name on the door. Successes often come from other people, and I get to take the credit for them. But that's kind of, it's a bit of a, again, it's not a very satisfying answer, because I don't reckon, some people will come on your podcast maybe, or maybe they won't. Maybe you'll be great people who'll say, I have the answer. I have the system. I will do this thing over and over. I will make money. I tend to call BS, or at least say, gee, you've been very, very lucky. It's rare you can be absolute about that sort of thing, particularly through market cycles, particularly through changes, and always be right all the time. I kind of try to go back to what's the underlying earnings power? Is it a pretty attractive price on that basis? If it is, I don't really care what style it fits into, or what the company is, or what it's done in the past, what it's going to do. And for as long as it's likely to keep doing better than the market, we'll hang on to it. If it won't, then of course we'll sell it.
I'd love to drill down there, Scott, on how you personally set up your portfolio, though, on the back of those principles. Like, do you take a core and satellite approach and have like some index ETFs and then stocks, or do you have a portfolio that's just stocks? And if so, like, how do you have any like weighting rules and stuff like that? Like, how do you take all the principles you've applied and actually build your personal portfolio around them?
So I'm going to be honest, and then I'm also going to say, do as I say, not as I do. And that sounds horribly hypocritical, and it is, right? And the reason it's hypocritical is because I'm a different person to most of our members and probably most of your listeners. I'm not better, I'm just different. I've been around doing this for a very, very long time. I have an cast iron stomach for volatility, right? I don't like it, but I've not freaked out. I've invested in the .com crash, the GFC, the COVID crash, and I don't think I sold anything in any of those 3 times, right? Not because I'm a genius, not because I'm clever, not because I knew what the future. I just have a stomach for volatility. It doesn't worry me. I don't like it, but it doesn't worry me. So what I do, what other people should do because they're different people, is really, really, really important. So, by the way, 95 plus, probably close to 99% of my portfolio is invested in companies I recommend. So I very much believe in eating your own cooking. So I will say that. But the weightings and the style and the approach I take is very much one that suits me because I know myself. And that's probably rule number 1, right? Know yourself. Almost all of my investments are stocks, not ETFs. With one massive exception, which is the NASDAQ ETF, which I own largely because I wanted ASX-listed exposure. Now, I own US stocks as well, by the way, but I wanted ASX-listed exposure to the NASDAQ index. I guess I could have sent the money to the US and bought it in US dollars. Didn't really need to, so I did. So I own it here. I do own some ETFs on behalf of my young bloke, a Vanguard Australian ASX 300 ETF. VAS is the code. I own VGS, which is the Vanguard Developed World, and I think VTS, which is the Vanguard Total US Market. On his behalf, I have some Vanguard Global in my super fund, that ETF, and I have the NASDAQ ETF. So, but it's not a core and satellite, I guess. So I want to explain in the context and then come out. So I didn't do that and then say, I'm going to make that the bulk and then add to it. I invested in the NASDAQ because I wanted exposure to the NASDAQ specifically. And rather than buying the individual companies on US exchange and US dollars, I thought, well, these are the companies, speaking of taglines, but I genuinely believe companies on the NASDAQ are the ones literally inventing the future, right? Sounds like one of those great taglines, but it's genuinely true. Think about NVIDIA, think about Netflix, think about Amazon, think about Google, think about Apple. I own some of those. Those are probably the ones that are going to be inventing the future. Or if they're not, the ones that come up behind them are probably going to be in the NASDAQ. So I want exposure to that. So that's why I own that one. I own global because I believe in global diversification. Do I want to buy stocks on the US exchange, UK exchange, or Germany, or New Zealand, or Japan? No. Not because I don't like them. I just don't want to spend the time and effort. So I have that because it adds diversification. Largely other than that, though, I do invest in individual stocks. But I think ETFs are spectacularly good for most people. I think Buffett said that 95% of people should buy ETFs. I completely agree. Now, people are spending time listening to this, listen to me jabber on. Firstly, I need to get something else to do that's more exciting. But secondly, if you want to get involved and do your own research, I think buying stocks is great. So I really think it's a great thing to do for people if they feel like they can and they want to and they have the stomach for it. If you don't, buy broad, super low cost, diversified index ETFs. Go fishing, go shopping. Listen to the podcast while you're doing a run or mowing the lawn. That is great. People in my job are supposed to say, no, ETFs are terrible. They're rubbish. Buy stocks instead. Buy my newsletter. ETFs are spectacularly good. They're wonderful. More people should own them and more people should own more of them. So that's the do as I say bit. The do as I do bit, mostly individual stocks. Overwhelmingly, individual stocks by market weight. It must be 90%. I think of my portfolios in individual stocks. In terms of weightings, again, please do as I say, not as I do. I have 3 positions that are each more than 15% of my portfolio for a combination of growth and adding to them regularly. One is the NASDAQ ETF. I'll give you the other 2. Why not? Soul Patts and Brickworks. Both those still, they're big. Why? Because they're big, diversified, successful, long-term outperformers that I feel really great about owning. I bought them and I bought more and they've gone up. And by the way, they're probably the ones I've held the longest of my current portfolio. Soul Patts, I think I've owned for years and years and years. So part of that is just the natural growth. Part of that is adding more money to it regularly. I have probably 7 US stocks and probably 15 to 18 Australian. I got criticised on social media, by the way, guys. I couldn't name for you now, in order, my top 5 stocks by weighting. And I got roasted on social. How can you not know that? You're supposed to be a professional. Why would I take advice from you? And the answer is, because why would I obsess about memorizing market weightings and position sizes? Like, it's just not. Again, I'm a long-term investor. It doesn't matter. And people say, what do you mean it doesn't matter? I like the companies I own. I like the proportions. Why would I obsess about whether it's 11%, 9%, or 13%? It's just irrelevant. Yeah. So I have big weightings in a few, largely because they've grown in size over a long period of time, largely because I like them a lot and I feel good owning them. I think one of them might be 20%. I wouldn't recommend 20% in a stock for anybody. Why? Because if a fifth of your portfolio falls by 10%, you hate that. That sucks, and you're annoyed and you're angry and you're probably going to sell and you're probably going to yell at me. So you do you. Most people need more diversification because it lets them sleep at night and it stops them freaking out when markets fall. And that's why I say to people, be diversified. Probably own more stocks than I do. Probably don't own the same weightings as I do, unless you know that you're like me. Now, people say, oh no, I'll it's like margin lending. I'll use it responsibly. Other people won't, but I'm better than that. And I say to people, well, yeah, but 90% of us think we're above average drivers as well. So be a little bit humble, know yourself. I should have had that weighting when I started. I've had some horrible missteps. If you've got enough time, I'll bore you with them, but hopefully you don't have enough time. I've made some terrible mistakes early in my career, right? So I've sucked a lot. But you learn from those things. Even what I do now, I shouldn't have been doing when I was 21, because that would have been stupid. I didn't know enough. But as you develop and grow and find out who you are as an investor, you can then tailor your style. Having been through a couple of crashes also helps before you start locking that in, because then you really, really know what's going to happen when the proverbial hits the fan.
Well, Scott, drawing on all of that experience, all of the mistakes you've made, the losses you've had, even the wins, and a lot of the framework and philosophy that we've spoken about over the last half an hour or so, and perhaps you're doing it for your son right now, but how would you take all of that, and if you were to set up a portfolio for a retail investor for 30 years, can't touch it, just leave it, what would that look like?
If you genuinely couldn't touch it for 30 years, the only answer is an ETF. If you said to me, guys, lock it in until 2054, let's come back and chat, I might not be here, you guys will be, then it would be an ASX ETF and an international ETF of some form, and that'd be it. Why? Because the ETFs rebalance themselves, and I'm not taking company-specific risk. I love Soul Patts. I love Berkshire Hathaway. I own them both. If I had 10 years, I'd happily put them away for 10 years. If you had to go over 30 years, do I know that I know in 30 years' time these businesses are going to be around and successful and not have blown up, had fraud, whatever? No, absolutely not. So as much as I don't think they would I risk my portfolio on that small probability? No, God, no. So ETFs is the only answer.
Nice.
If you let me come back to say 10 years, I would say ETFs, again, for most people, I've just said, should be the bulk of the portfolio. Why? Because the market result is great. You know, we used to use the word average like it's bad. Oh, that's a bit average, isn't it? Average is fantastic. Average on the stock market is wonderful. If you can't beat the market, buy the market, man. You get super. What is the ETF? Some of those are 0.04%.
Yeah, I know.
Management fees.
Yeah.
Right, and you get the market return. You do nothing. You buy it, you go fishing. In fact, I advised a friend recently. I'm not allowed to give them personal advice, but they ended up going effectively 2 ETFs. That was it, the entire portfolio with a lump sum. And they just get the dividends every 6 months and they're happy with it. That's like, why would you not do that, right? So that for most people, that's exactly the right advice. But if you're going to do individual stocks, be diversified. If you're going to do it for any length of time, have many companies in there. Now, if you have ETFs, you don't need as many companies because the ETF does most of the diversification for you. If you're half in ETFs and half in stocks, half your portfolio is 300 companies, right? So you're more than covered. But be diversified, be long-term. Don't worry about what's happening in the market now. Careful of trends and fads. Afterpay is a great example, guys. If you'd bought Afterpay and then promised not to sell it for 30 years, you rode up, you looked like a genius. Then they sold out to Square. The Square share prices crashed, and who knows what the future is for Square. Things change, right? I'm not saying it's going to go terribly necessarily. I'm not overly bullish on some of what Square's doing. I love the payment terminals and the payment network, but who knows, right? So it's a very, very, very long time. Be diversified, be sensible, be long-term. The longer you're locking your money up for, the more conservative you should be in analysing the business's underlying fundamentals. That is, in 5 years' time, Afterpay might go up. In 20 years' time, are we even using Afterpay? I don't know. Most of the companies, Woolies is probably okay. But what's going to happen to ResMed's a great example. I like it. I've recommended it. I like it a lot. But do drugs, make sleep apnea, obsolete? Possibly, yeah. Would you want to bet on a long-term basis that was the case? No. So the longer you go, the less you want to be exposed to fads, the less you want to be exposed to technological kind of change or disruption. So be more conservative the longer you're investing. Be diversified, and again, have that long-term view. Know that over 30 years you'll have, on average, 4 recessions. You'll probably have, on over 30 years, 15 corrections. You'll probably have 5 or 6 bear markets. You'll probably have at least 1 crash. Man, think about it. Since 2025 years, the dot-com crash, the GFC, and the COVID crash. I mean, 30 years' time, so maybe another 3 of those. That is going to be the life of the investor. But, and 30 years is a great number you asked, because we all know the Vanguard index chart, right? My absolute favourite. The market went up 13-fold in Australia over that last 30-year period, despite all those things I just talked about.
Yeah, love that. Now, Scott, we want to draw out a couple of final lessons for our audience that you can leave us all with to think about as we get ourselves set for 2025. If you take yourself back to a younger Scott Phillips, maybe a fuller head of hair, sitting around the dinner table, hearing that the stock market was like a casino from your folks, what's one lesson that you wish you could tell that young Scott Phillips and that you could tell every young investor today?
One lesson. I'm trying to distill a few thoughts into one answer, so it sounds like one lesson. I'll break it up. So, start, invest regularly, stay the course, and be diversified. They're probably the 4 X. If you stay the course with the wrong stock, you're going to get smashed. Yeah. So I'm assuming you're investing a decent portfolio. The young Scott Phillips did something really stupid. The young Scott Phillips got a promotion at work, and back in the day, you used to get a car allowance if you had a certain level of seniority at a company, right? It's all wrapped up now in your package. Car allowance. So you can take the money as cash, or you can lease a car. And I went, well, I'm getting extra money. It's free money. I might lease a car. And so I leased a $64,000 Volkswagen Passat. I was a value guy. I wasn't going to go the Audi or the BMW. That's wanky and expensive. I'm going to go the Passat because it's a solid European car. Really, it was a lovely car. I loved driving it. But cheaper than the other stuff. So it's a smart idea, right? When I look at the value of, and this is me being the boring finance nerd, when I look at the compound value of what I spent on that car, what I got for it, had I invested that instead, I probably cost myself a 7-figure retirement, right? That's literally what compounding does. And I use that example, firstly, to say I'm an idiot. Secondly, the value of if you can start young, you can lag the market by a couple of percentage points a year and still retire a millionaire, right? You don't have to be very good. In fact, people say, oh, you're young, you can take more risk. I would say exactly the reverse. You're young. Why the hell would you take the risk? You can just let compounding do the work for you and retire really wealthy. If you can save regularly, invest it half decently, even reasonably ordinarily, you can lose to the average and still do really, really, really well. Now, don't lose to the average, buy an ETF or beat the market, but they're your opportunities, right? So I really want to tell people, yes, by the way, investing shouldn't be exciting. Again, next Afterpay, right? That's our marketing. Once we get you inside the door, we say, thanks for coming. We'll try and find you next Afterpay. By the way, this is not about hitting refresh on your computer. This is not about making 100% returns in 6 months' time. This is not about the ups and downs and the dopamine and the excitement. If you want excitement, go to the racetrack. Investing should be slow and boring. ASOP, the more I learn about investing, guys, I've mentioned ASOP's Hare and Tortoise way too many times in the last 12 months because whenever I come back to it, it's literally just that. We know. We were told thousands of years ago. How do you invest? Well, be the tortoise. Just be the tortoise. And compounding is so magical. It does the work for you. Get started. Invest regularly. Stay the course. Be diversified. 99% of people who do that will be extraordinarily stoked on retirement with how much money they've amassed.
Nice. Can't wait for my retirement. So, Scott, to close out, is there any conventional wisdom in the industry that you think is just outright wrong or should be ignored?
Yes. So let's just say one. Let me tell you. Simplest one is you don't have to be an expert. Don't believe you can't do it. Because if you just ETF, like the money that is extracted by our industry is atrocious, is genuinely atrocious, right? I say to someone who works for a for-profit business who sells investment newsletters, but the amount of money extracted from people in the finance industry should be, it's not quite a crime, but it's not far off it. You can do it. You can do it yourself. Don't believe it. You need other people's help to do it. Don't believe you need to be at the top of the tree. You don't need to win investing. Yes, someone's going to come first. Someone's going to come fifth. Someone's going to come 85th. Someone's going to come 4 millionth. You don't need to play that game. And so everything dressed up to say, we're smart, we've got insights, we can help you, we will win. What am I talking about? I'm talking about greed. Now, not greed as in we want to make money, right? So there's maybe there's good greed. Maybe we want to use a different word. I said a bit Gordon Gekko if I'm not careful. But, we all want to make money, right? So do that. But the greed to get the nth degree of return, to make this extra bit of money, you need to do this, take this risk, buy this system, invest with me. I've got the insights. I'm the only one who can help you. There's lots of people who can help investors. The Motley Fool can, Equity Mates can, lots of people can. You mentioned some of the guys before. Owen Rask is doing a spectacular job with Rask Investors. So I shouldn't pick one out over the other guys, but he's out there helping people invest. Like this is a great industry, right? For all of the fact that Equity Mates and Motley Fool and Rask might be competing for members or readers or investors or eyeballs or ears in this case, there are real forces for good out there trying to help people. Don't believe you have to pay a fortune. Don't believe you can't do it yourself. Don't believe there is someone out there. The smart money is a myth. It is an enormous, enormous, enormous myth. How do I know? Because 80+% of funds lose to the market every single year. Right? So I know that's the message you guys preach. You're doing a spectacular job. I'm glad you're doing it. More voices we have. Scott Pape's another great one. There's a real groundswell of people saying, you know what? Investing isn't what they said it was. Investing can be done well, simply, easily. Jack Bogle deserves whatever prize we can throw at him, and then 15 more for inventing the index fund. Don't believe you can't do it. You absolutely can. You can do it simply. You can do it easily. A little bit of knowledge. If you want to do more than that, if you want to buy stocks, great. But just start by diversified, low-cost, broad-based index fund. Go fishing, go shopping.
Love it.
Well, I love it, Scott. Well, every time you come on, I'm reminded of how much I enjoy listening to you. These interviews are always full of little nuggets of wisdom, and I'm sure everyone listening today will have been furiously taking notes and will re-listen to this over the summer break. Absolute pleasure, as always. We appreciate the work that you do in helping to educate us as well. So thank you very much.
Guys, an absolute joy being with you, Bryce. Thanks for your time.
Thanks, Scott.
Now, before we go, a huge thank you goes to Viola Private Wealth for their continued support of this series. Creating a lasting legacy requires thoughtful planning and expertise. Viola Private Wealth brings a blend of tailored strategies and decades of experience managing assets to help ensure your wealth benefits generations to come. For more information, head to violaprivatewealth.com.au.
Now, we've got 2 more episodes in this series and you don't want to miss either of them, so make sure you're subscribed wherever you're watching or listening. Next, we've got Will Dowd from Fairlight Asset Management. Fairlight are a boutique small and mid-cap manager. They invest globally, and every time we get anyone from Fairlight on the podcast, they share with us companies that we had no idea about. Just fascinating companies that we're being introduced to for the first time. So you don't want to miss that one. And then we close this series with Mark LaMonica from Morningstar. Morningstar is one of the biggest stock market information services, research houses. But they have a particular focus for retail investors. There are some other ones that are more focused on the institutional world, but Morningstar have a wealth of information for retail investors like us, and we're going to try and drag as much of it out of Mark LaMonica as we can in one 40-minute interview. So 2 great interviews to close out the series. You don't want to miss either of them, so make sure you're subscribed.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.